You've worked hard, you've earned your equity. And if you're like most of the executives that I work with, a significant chunk of your net worth is sitting in one single stock, your employers. Now, here's the uncomfortable truth. If more than 20% of your net worth is in a company stock, you have a concentration risk problem. And most executives know it. The hard part isn't wanting to diversify. The hard part is figuring out how to do it without handing 30, 40, or sometimes even 50 cents of every dollar straight to the IRS. In this video, I'm going to walk you through exactly how to do it. The strategies that financial planners use with executives to reduce concentration risk while keeping more of what you've earned. Let's get into it. Let's start with why this matters so much. Think back to companies like Enron, WorldCom, or even more recently, SVB. In each of those cases, there were employees, smart, accomplished people who had a huge percentage of their retirement savings tied up in company stock. When those companies collapsed, they didn't just lose their jobs, they lost their entire financial futures. Now, I'm not saying that your company is going to go under, but here's the thing. Concentration risk isn't just about catastrophic failure, it's about something much more common. A bad earnings report, a change in leadership, a sector rotation, a key executive departure. Any of those can knock 30 or sometimes even 40% off a stock in a matter of days. And unlike a diversified portfolio, which absorbs those shocks, a concentrated position takes the full hit. There's also a psychological trap that keeps a lot of executives stuck. Selling company stock can feel disloyal, like you don't believe in the company. I hear this all the time, but let me reframe it. The company is already compensating you in stock. Your income, your bonus, your equity, it's all tied to this one company. Your financial plan doesn't have to be as well. The general rule of thumb that I use and most financial planners use is no single stock should represent more than 10 to 20% of your investable assets. If you're above that, and most executives with RSUs and options are, it's time to make a plan. So, if concentration risk is so obvious, why don't executives just sell? 4 reasons. The first is the most obvious: taxes. If you've held appreciated shares for more than a year, you're looking at a long-term capital gains tax rate, which can be as high as 20% federally, plus the 3.8% net investment income tax, plus state taxes. So in a high tax state like California and New York, you would easily be losing 35 to 40 cents on every dollar you gain. On a $500,000 position, that's a $175,000 tax bill. Second is ISO complexity. If you have incentive stock options, selling the wrong shares at the wrong time can trigger what's known as alternative minimum tax, which is a separate tax system that can result in massive unexpected bills. The planning here is highly specific to your situation. Third is trading restrictions. Most public companies, executives, and insiders are subject to trading windows, specific periods when you're legally allowed to sell. Outside of those windows, you're locked out entirely. Some companies have what's called blackout periods that can span most of the year. And fourth is emotional attachment. This stock represents your work, your loyalty, your belief in where the company is going. That's real, but it's not a financial plan. Here's the good news. There are strategies that address all of these obstacles, and in many cases, let you diversify with a fraction of the tax hit. So let's go through them. Strategy number 1, stage selling over multiple years. This is the easiest strategy and often the most overlooked. It's just spreading your sales out over time. Instead of selling everything all in one year and taking one enormous tax hit, you sell a portion each year and stay within a lower capital gains bracket, or to avoid bumping your income into a higher tier. For example, if your total income, including salary, puts you just below the threshold of the 20% long-term capital gains rate, you could sell just enough shares to keep you under that threshold. Done over 3 to 5 years, and you diversified your position while staying in that 15% rate the whole time. It's not glamorous, but it works. It's available to anyone who's in a trading window. Strategy number 2, donor advised fund. If you have any charitable inclinations at all, and I mean any, this is one of the most powerful tools available to high income executives. Here's how it works. Instead of selling your appreciated stock and then donating the cash, you donate the stock directly to the donor advised fund. When you do that, 2 things happen. 1, you get a charitable deduction for that year for the full fair market value of the stock, not what you paid for it, but what it's worth today. And 2, you pay 0 capital gains tax on that donation. 0. The donor advised fund then sells the stock, also tax free, and reinvests into a diversified portfolio. You can then grant money from the DAF to any qualified charity over time on your schedule. So you've eliminated the concentration, avoided the capital gains, and got a deduction, and supported a cause you care about. That's as close to a financial win 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 as it gets. Strategy number 3, exchange funds. This one is a little less well known, but incredibly powerful for executives with very large concentrated positions. An exchange fund is essentially a partnership where multiple investors, all with different concentrated stock positions, pool their shares together. You contribute your stock, and in return, you receive a proportional interest in a diversified fund that holds all of the contributed stocks. The key benefit: this is not a taxable event. You don't trigger capital gains when you contribute. You've effectively diversified without selling. The catch: these are only available to accredited investors who have a 7-year minimum holding period and require a minimum investment that typically starts in the millions. But if you're in that position, it's worth knowing about. Strategy number 4, Charitable Remainder Trust, or a CRT. A CRT is more of a sophisticated structure that works especially well for executives who are approaching retirement and have large, low basis stock position. Here's the basic idea. You transfer your appreciated stock into an irrevocable trust. The trust sells the stock with no immediate capital gains tax and reinvests into a diversified portfolio. The trust then pays you an income stream for a set period of time or for life. When the trust terminates, the remaining assets go to charity, hence charitable remainder trust. You get a partial charitable deduction up front, a diversified income stream, and deferred capital gains. The charity gets the remainder. It's a strong option if philanthropy is a part of your long-term plan. Strategy number 5, collars and protective puts. What if you still are in a blackout period and can't sell at all? Well, hedging strategies can provide downside protection even if you're restricted from selling. A protective put gives you the right to sell your stock at a set price, essentially ensuring against a decline below that level. You pay a premium for that insurance, similar to any other form of insurance. A collar combines a protective put with a covered call. You cap your upside in exchange for limiting your downside. This can sometimes be done at low or zero net cost. These are more complex strategies that need to be structured carefully, especially around the 10b5-1 plan requirements and SEC regulations for insiders. But for executives who are locked up and are worried about a declining stock, they're a legitimate tool. Strategy number 6, tax loss harvesting elsewhere in your portfolio. Finally, and this is the one most people often overlook, if you're going to sell company stock and realize gains, you can offset a portion of that tax by strategically harvesting losses in other parts of your portfolio. If you have other investments that are sitting at a loss, selling those in the same tax year creates a capital loss that directly offsets your capital gains dollar for dollar. Up to $3,000 of excess losses can even offset ordinary income, and the rest carries forward into future years. This won't eliminate your tax bill, but it can help meaningfully reduce it. And it's a strategy that should be part of every executive's year end planning conversation. Now, I want to take a minute to walk you through how I actually approach the strategy with clients, because the right strategy is almost never the same twice. When an executive comes to me with a concentration problem, the first thing I do is pull up their full financial picture, not just the stock. I want to see their tax bracket. I want to see their vesting schedule, whether they have a rollover IRA that could affect other strategies, what their liquidity needs look like over the next 3 to 5 years, and whether charitable giving is something they care about. Because all of that shapes which strategy or a combination of strategies actually makes sense for them. I had a client not long ago, a VP of engineering at a public tech company. He had about 60% of his net worth in a company stock. He'd been told by a friend just to sell it and be done with it. We ran the numbers, and selling everything would outright have cost him close to $200,000 in taxes in a single year. Instead, we built a plan that combined stage selling over 3 years with a donor advised fund for the portion he was already planning to give to his alma mater. Between the tax savings from spreading the gains out and eliminating the capital gains on the donated shares, we reduced his total tax bill by over $80,000 compared to selling outright. That's money that stayed in his family's pocket. That's the kind of planning that I do for executives. If you're sitting on a concentrated position and you've been putting off dealing with it because the tax hit feels a little too painful, that's exactly the problem I help executives solve. There's almost always a better path than just selling everything at once. So, how do you know which strategy is right for you? Let's start with these 3 questions. Question 1, are you currently in a trading window? If not, hedging strategies are If you're not, hedging strategies are your only near-term option. If yes, you have the full menu available. Question number 2. Do you have any charitable goals, even modest ones? If so, a donor advised fund should be your first move before you sell a single share. Question number 3. How concentrated are you? And how quickly do you need to diversify? If you're at 30% in a company stock with a long runway, stage selling is clean and simple. If you're at 70% and worried you may need a combination of strategies, the answer to all three of those questions shapes your entire approach. And the sooner you start thinking about it, the more options you have. Look, having a concentrated stock position isn't a failure. For most executives, it's just a natural result of years of equity compensation doing exactly what it's designed to do. But holding it forever because the tax bill is uncomfortable isn't a strategy, it's a risk. The good news is you have more options than you probably realize. Stage selling, donor advised funds, exchange funds, charitable remainder trust, hedging, tax loss harvesting, any one of these or a combination can make a meaningful difference in how much you keep. If you want to talk through your specific situation, how concentrated you are, what strategies might apply, and what a plan would actually look like, I'm offering free consultations for executives. The link is in the description. If this video helped you think about your equity differently, drop a comment and tell me what percentage of your net worth is currently tied up in company stock. I read every comment and reply. Subscribe for more content like this every week, and I'll see you in the next one.